order. Let's go to the next slide, okay? Impact of merchandise inventory on financial statements. Errors in the inventory will cause errors on the income statement and the statement of equity and the balance sheet. We talked a little bit, didn't we? What happens if you don't count the inventory correctly at month end? If you undercount the inventory, you are going to understate your net income. If you overstate the inventory, you're going to overstate the net income. Inventory balance should have been $10,000 and you only counted five. That 5,000 flows out as a loss into your income statement for that month. But it also screws up the next month too, because you're starting with an incorrect beginning inventory. And this is the concept we just want to get across here. Understanding the inventory has the following effects. Understating. You're understating. Your net income is going to be understated because your cost of goods sold is going to be overstated. And of course, that's going to foul up your assets and capital. Overstating the inventory is the opposite, okay? Think of it this way. You counted a phantom asset that wasn't out there. You're telling the world that you still have it available for sale when it's really gone and you haven't recorded that sale. That's what that means. The key thing after this, though, is look what happens in the following month, Lori. This is what we want to talk about. We have here, and I need to move something here. Get this over here. I'm filled with malware, maybe. Okay. Let's look at the inventory here for this company. The ending inventory at the end of 20-1 is correct. The inventory is correct. So we bring it over as the new beginning inventory next month, and hopefully that month is correct, okay? But look what happens, Lori, if we undercount. Here we only counted $15 million. Big company, right? Mm-hmm. We only counted 15 and we should have counted 20. When we did things correctly in the first pair of columns, the income was 30. By failing to count 5, look what happened to our net income. Mm-hmm. Now, what you're going to see is that the next month is going to have a problem, okay? Because we go into this period and we're starting with a wrong beginning inventory. We have no choice. And the impact in that month, look at that. We're overstated by 5,000. Mm-hmm. So inventory mistakes, when they're big, can be killers. You're setting yourself up for 2 years of heartache, perhaps, huh? Although I'll say this, in the real world, companies close every month, right?
Right.
So we're really talking month to month. And I'll just tell you a little side story. I worked most of my career for Thomas & Betts company, headquartered in New Jersey, that threw me out in Los Angeles. We had a lot of intercompany transactions. In other words, my factory sold plastics to a factory in Montgomeryville, Pennsylvania, and they sold. And we made mistakes on the intercompany accounting. And that really angered the management because that threw not only the overall company number wrong, but the individual subsidiary numbers wrong too. And they actually flew all of us back from all over the world to yell at us one day. I was lucky because my division was small. We were a tiny place. So my intercompany responsibilities were not nearly as big as others. But boy, that was a disaster. And that's what happens though. You undercount, overcount, okay? You overcount, you're going to look good this month and you're going to look bad next month, okay? So you just have to kind of just keep that in your mind there. Students come to the test, Lori, and they get a little confused even though they've gone over this. What did Bob say? If we overcount, geez, I can't remember. And then what's going to happen in the third year after all of these?
So it should even out.
Yes, yes, the third year, exactly right. It evens out exactly right. Can you imagine if a company did this, had these numbers wrong for 2 consecutive, 24
No.
straight months? No way. Do you count any inventory? You don't have, do you have inventory in your business?
I do. I pretty much count it once a year.
There you go. Well, you've got your system under control there. That's what we want to hear. Counting is certainly a non-value added activity if ever there was one, huh?
Right.
Describe 2 principal systems of accounting for merchandise inventory: the periodic, which we're now all experts in, and the inventory count balance must equal the most recent physical inventory. Purchases account used for all merchandise purchases. We've been debiting purchases, which is a cost. And then we're using that to add to the beginning inventory and then subtracting the end. Merchandise inventory under the periodic system, merchandise inventory and cost of goods sold are only computed at the end of the accounting period. And that's the only time we touch the inventory account. So, of course, under the periodic, we never know really what our inventory is until we count it. Perpetual inventory account reflects current inventory. Purchases are debited now to inventory. We're going to call it merchandise inventory. We're going to debit merchandise inventory, and we're going to credit the inventory when we sell something. Okay. The only time you're going to touch cost of goods sold, for the most part, is when you sell something. Mm-hmm. And with the perpetual system, there's no need for end of year adjustments if the physical inventory agrees with the amount reported in merchandise inventory. You may or may not be forced to take a physical inventory. I'm not exactly sure what the rules are for companies on the Dow Jones, the big ones, but I believe they do have to actually count once in a while. Where I worked and where many companies emulated us, we took what were called cycle counts. Have you ever heard of that expression? Mm-mm. Cycle counts. We had, say, 10,000 part numbers, and they were divided into A, B, and C items according to the value. And every day I chased somebody from my department downstairs, including myself once in a while, to count maybe 4 items that we selected at random. Mm. And if those 4 counts were okay, and the next days were okay, that gave us a little bit of comfort that things were good. We saw one go off, we call it noise in the system, we kind of don't worry about it. Next day, if you got another one, you may have a problem. So perpetual inventory system, we are debiting the inventory and no adjustments at year end. This grid here, Lori, is a real important one to take a look at, okay? Here, we're going to show you the journal entries we already know from the periodic system and compare them to the perpetual. Excuse me. As Jackie Gleason used to say, that's good booze. I love Jackie Gleason, but okay, I digress. Look at the difference in the transactions. We purchased merchandise. I've been teaching you guys you debit purchases and credit AP, right? Now we're going to put it into merchandise inventory. This is an asset account, of course. Merchandise inventory is an asset account. Look at the freight bill. This is kind of interesting. Freight in, we included it with the purchases, really. Freight in, we would debit freight in expense. Freight in now, Lori, is part of your inventory. You just debit it to merchandise inventory. Freight in, when we were calling it an expense, it ends up in the ending inventory when you go through the calculation. Beginning inventory plus purchases plus freight in equals available minus ending. Here, we're putting it right into merchandise inventory, okay? Look how a sale is handled. We sold something for $80. We bought it for $50. In other words, that's the cost of goods sold, $50. Under periodic, debit AR, credit sales, Same thing there, right?
Mhm.
Note the other journal entry we write. We debit cost of goods sold and we credit merchandise inventory. It's perpetual inventory system. We're going up and down every day as goods come in, goods go out. This here, everybody, this 4-line journal entry, you can do this in 2 separate entries if you like. When you go into your exercises, I think they mix it up a little bit. Sometimes they want you to do it separately and sometimes together. I think all together makes sense to me. Let's take a look at a return, okay? Merchandise costing $10 was returned. We've been crediting purchase returns and allowances. We're returning something. We were doing the returning. Here, we're going to use the contra cost account. Remember? The contra purchase account. Here, you don't have those type of accounts for purchases. What did you return? We returned inventory. I bought inventory from you, Lori, and now I bought $1 million and $10 was no good, and you agreed to take it back. So it comes out of my inventory and reduces my payable. This little grid here is a little tricky, and you just have to go over this a little more. Customer returns something for $20. Now we are the ones with a customer who's unhappy with us. Somebody returned an item that we sold for $20 and the cost was $15. We learned so far, you never debit sales, you debit the contra revenue account and credit accounts payable. That's the same part. That's the same entry for merchandise inventory. But again, you must consider the cost. So we put our merchandise back into the inventory. It's still good. We can sell it to somebody else. And we reduce our cost of goods sold. Make some sense, Lori, what we're talking about here?
Yeah, it does.
This is a little more interesting, I think, a little trickier. And here we go. We paid for merchandise and we got a 2% discount. Well, let's see here. That means we settled $100 of AP, which has a credit balance, and now we debit accounts payable. We only had to pay $98, and we credit purchase discounts. Remember I said there's no purchase discounts and there's no purchase returns and allowances under the perpetual system when we're working with merchandise inventory. So here we go. We paid down the payable. We got our merchandise in and cash. Okay.
So why would
I don't like with something that doesn't look right, does it?
why would a company use one over the other?
Oh, 99% of the world would hope, everybody would hope to use a perpetual system only because you know every day how much inventory you have. Every day you know what your costs are. Every day you can print out a quick income statement to see how we're doing. You call Costco and you inquire about some of those big screen televisions, and you say, I need to buy 6 75-inch TVs for my college. Do you have them in stock? They're going to hit one button and know immediately how many they have. They're going to say, we have 10 here. Would you like me to reserve 6 of them? You know what I mean? And you can, do your business. If you call a smaller store, the person is going to put you on hold and go out in the back and see what's out there. So the perpetual system, if you have a decent one going, is far superior. Periodic is okay. It's just that you're never going to know exactly how you're doing as a company, financial statement wise, until you do what? Count the inventory. And under the perpetual inventory, you will have to take a full inventory at least once in a while. That's my story on that, and I'm sticking to it. You will have to take it once in a while. Compute the costs allocated to the ending and cost of goods sold. I hope you like this section, Lori. If you master this section, you'll be way ahead of the class in 2:30 because they get bombed with this, okay? We are going to compute the cost of goods sold and the cost in the ending inventory. And we talked a little bit about, excuse me, to determine the cost of goods sold, we need to understand the purpose of a physical inventory and specific calculations used and the role of lower of cost or market. Well, we know the purpose of a physical inventory. We want to know what's out there and make sure we got decent numbers. Specific calculations used under the periodic and perpetual systems. We're going to get to that in a moment. And a rule, lower of cost or market, a basic accounting principle under the heading of conservatism, okay? Taking a physical inventory. Ah, goodness gracious. Counting at the end of the period, you must do it under the periodic system. And it's used to allocate merchandise costs between sold and unsold goods. That's all the periodic gives us, Lori. It tells us at the end of the month, we have $1,000 available for sale. We had 10 books at the beginning. We brought in 10, we purchased 90 more. That's 100. And then we count and we find out we have 40 books left, meaning we sold 60, okay? The perpetual system is going to do that for us every day, basically. And we're going to compare, what is this thing doing to me here? Compare it to the, we're on the perpetual system, we're going to count and compare to our perpetual and see if it agrees. Some companies even close for a few days to take inventory. And you've probably seen that, maybe not your business, but have you ever gone to a store and it's closed for a day? Yeah. Frequently done after regular business hours if you can. Some companies even close for a few days to take inventory. We did, at Thomas & Betts, we did. And the most memorable inventory we took, we had a bunch of big shots out from New Jersey. They came out to, quote, observe our physical inventory. The real reason they came out here was because it was Los Angeles and not the place in Jacksonville, Arkansas, okay? So these guys were out here on a junket, really. So the night before the inventory, I took them through the process, showed them, how we prepared for it with tags and things. 7:20 the next morning, October 1st, 1987, was the day of the Whittier Narrows earthquake. I don't know if you're familiar with that or remember it.
Oh, I don't know, not that one.
That was it was pretty devastating. Needless to say, the inventory was canceled. Our building was condemned after that.
Wow.
We had an old beat up building. So the business, so needless to say, that was quite a day. The building was condemned and we had to get out of it by the end of the year. In other words, the engineers from Los Angeles said, well, we think the building will stay on its own legs for 3 more months. And we ended up having to rent that, not rent, but we purchased a new building. I digress. Physical inventories. The ideal time to count inventory is when the quantity on hand is at the lowest level. I guess some people can do that. I guess that's why department stores have their closings typically at the end of February. Did you know that? The fiscal year, and you can understand why.
Sure.
They're busy from Christmas sales. Maybe January is busy with returns. February, you get a little breather. The inventory is probably much lower. Let's count, okay? Not all companies can do that, though. And we know what a fiscal year is. It starts and ends when inventory is normally at its lowest level, known as a natural business year. What? A fiscal year that starts and ends when inventory is normally at its lowest level. I'm not sure I've seen that. Typically, if you want to talk about a fiscal year, we're not, a calendar year is normal, right? Fiscal year, as you know, can be anything. Like I said, department stores tend to want to close the fiscal year at the end of February. General Mills and Kellogg's are two companies you're familiar with. And I use them in 2:30 to do what's called these financial statement analyses. And their fiscal year begins with the planting season and ends with the harvesting. And that's how a lot of fiscal years were set up back in the old days, if you will. Okay. This school year can be whatever you like. And when I took a job up here in Santa Barbara in 1999, I worked for the first time with a company that did not have a calendar fiscal year, and it was annoying to me. Jocelyn Electronics up on Hollister, we closed on May 31st, and nobody knew why. That was our year end, but I digress again. And this is kind of old fashioned, Laura. You're taking an inventory, right? We're counting an inventory, and somebody might be walking around with a sheet like this, and they come up to a table lamp and they write, oh, I count 20. I count 18. This is just, one simple way. You would never, never, never see the cost of an item or the extension of the dollars on an inventory sheet. I'm sorry, this is done afterwards. You don't necessarily want to bring in, some of your lower paid employees and tell them that the item they hold in their hand is worth $88. That's rather valuable. The inventory takers never need to see the costs of the goods, just the amount. Physical inventory. Oh, here's a good one. Oh, I like teaching this, huh? Physical inventory special considerations. Consigned inventory. You familiar with that term, Lori? Consigned inventory.
I guess, well, probably not in the context that they're talking about.
Okay.
I'm consignments. I know what consignment means, but it's probably different here.
Yeah, it means to give your product away to somebody in the hopes that they can sell it. Basically.
Oh, okay.
Here's what we're talking about. Goods held on consignment. Remember when Macy's was downtown and you walked into the store? The first thing you might have noticed was all those women schlepping perfume. They had the kiosk all over and you had that smell. That perfume was probably consigned to Macy's by Revlon, say, or Arpel, Arpege, whatever. Revlon's not. I want to name a perfume company for it.
Chanel.
That's the one I was trying to remember. Chanel has a deal with Macy's. They will say to Macy's, we're going to send you a couple of 100 jugs of perfume. You don't have to pay for it unless you sell it. So Macy's gets the stuff, and Macy's sells the bottle of perfume for, say, $100. At that point, they pay us $40, say, to buy it from us as prearranged. Consigned inventory. The key thing with the consigned inventory, it should not be included in the inventory of Macy's. Should not be included in the inventory of company holding the goods. That's our inventory. That's Chanel's inventory. So at the end of the month, they have to be alert enough to say, well, we got $100,000 worth of perfume at Macy's, at Nordstrom's, at all these small shops around the world, okay? Consigned inventory. You're giving it away in the hopes that the person getting it from you can sell it, and then they will buy it from you at the purchase price, okay? Goods in transit, FOB shipping point, huh? FOB shipping point, freight on board, free on board, freight on board is correct. Have you ever heard of FOB, Lori? What can I put you on the spot? What's your understanding of what that means?
Well, so it was confusing at first, but so it's about who owns the merchandise.
Absolutely correct.
Ultimately, who owns it, and at what point does the other entity take possession?
Hey, who's the professor here? That's what I'm supposed to be telling you. Yeah, you're exactly right. You're exactly right in everything you just said. Yeah, the FOB point. The FOB point is simply the point in time when ownership of the goods changes from the seller to the buyer. Exactly like you just said. FOB shipping point. It means that the shipper no longer owns it once it leaves the factory, right?
Mhm.
You have a factory, say, in your business, and in Santa Barbara here, and you load up a truck with $1 million worth of your product, as if it's FOB shipping point, as soon as that truck driver signs the bill of lading, as soon as he pulls out of your store, the buyer owns that now. If that truck had an accident 50 feet outside your place, you do not have to worry about it. That is the responsibility of the buyer. So FOB is the point in time when, like you said, ownership changes. FOB destination can be another one. Here, the buyer does not own it until he receives it. The FOB point would be the destination, meaning where they're shipping the stuff to. So if that truck has an accident going from Santa Barbara to New Jersey, and just as it gets off the New Jersey Turnpike, there's an accident, this time the seller is stuck with that. This can be an important consideration to companies. Companies sometimes fight over they want it FOB shipping point or destination. To give you an example, this one place where I was working for a few years, we had no money to make the payroll sometimes, which is not a good situation, right? We were short. It would be tough to make the payroll. But what I might be able to do was borrow. We had a revolver with a bank, a revolving line of credit, which you're probably familiar with, where the bank would say, I'll loan you 80% of your receivables and 70% of your assets. We don't have enough money to pay the bills. But what I could do was call up the supplier in Oklahoma and say, Jeff, can you get a train car full of resin for us, please? And let's make the deal FOB shipping point. As soon as he let that train go, I could add that to my inventory. And that was worth 100,000. I could then come up with 70,000. So there's a certain desire between these two. And of course, you could have FOB in Chicago once it goes across the Mississippi or something. Oops, let me get that down. Inventory cost components, okay? Under this method here, forgive me if I touch this again, see if I can do this without screwing it up. This thing has a bad touch today. Inventory cost components. The purchase price, right, is part of the inventory cost. Under the perpetual system, as we just learned, so is the freight. So might be insurance. When I say insurance covering the delivery of the goods, okay? And any storage fees in regard to the delivery. The common thing here is you're going to debit merchandise inventory, merchandise inventory, merchandise inventory, merchandise inventory for each of these. This is all considered part of your inventory. The cost will include all the necessary and reasonable costs. You know what else you could add there? Interest, I believe, on bringing that stuff in if there's any borrowing involved. Now we get into some fun, huh? Identical items are purchased at different times and at different costs per unit. Of the cost of goods available, beginning inventory plus purchases, right? How do we decide which units were sold and which remain? Well, on the old periodic system, we had to calculate that, right? We had to go beginning inventory plus purchases. Here, we're going to talk about 4 inventory methods, costing methods. And this is a whole chapter in 230. And you can do this under the perpetual or periodic method. We have 4 types: FIFO, LIFO, specific ID, weighted average, first in, first out. A company can choose FIFO to cost their inventory, which means that they are going to pretend that they always sell rather the oldest item first. First in, first out. Last in, first out is the opposite. You are pretending, and I'm using the word pretending deliberately, you are pretending under LIFO that you're always selling the newest item you received at whatever that price is. Neither of these methods have anything to do with the actual physical movement of the goods. We must understand that. The Mesa Produce Store up down the street from where I live, they use LIFO, huh? Well, that might mean that they never sold the first bunch of bananas they purchased after World War II. We know that's ridiculous, but that's what we're trying to visualize, okay? You're on LIFO, you're selling the new stuff, and FIFO, you're selling old first. Weighted average is easy, and I'll show you that. It's just coming up with an average and multiplying your inventory units and sold units. And specific ID, this is the one method, Lori, of these 4 which does match the physical movement of the goods. Specific ID would be big ticket items for the most part, or very expensive items. I mean, when I bought my my Maserati a couple of years ago, when I went into the place and made the deal with the guy, I handed him my check for, $2 million, whatever it was. He didn't say to me, go out into the parking lot and take whatever car you want. No, he had to know exactly which car. I ended up driving a Ford Edge off the lot for different reasons. But anyway, anyway, he didn't say to me, okay, Bob, good deal. Now there's about 20 Ford Edges against the wall. Take any one you want. No, can't do that. They have to know what the VIN number was. They have to know the color of the car, the markings. They have to know exactly in case it's involved in an accident, right? Specific ID. I would imagine jewelry. Well, I don't imagine. I know jewelry is kind of the same thing. These are things you need to trace. Okay, specific ID. This is the one that where the actual units match the costing. And if you ever get it, and I don't think there's many problems on this on your upcoming test, but it's fairly easy in that they tell you clearly, hopefully clearly, what happened. You might have a beginning inventory of 100, and then you bought 300 more, right? And then you bought 500 more. Specific ID, they're going to say, well, 50 came out of the beginning, 300 came out of the second layer, and another 100, say, came out of that. And you would cost out accordingly. They would tell you, of the sales of 300 this month, 100 came out of the beginning inventory, 150 came out of the next level, and then another 100 out of the third. And I'll show you this in a moment. Use usually practical specific ID only for businesses in which sales volume is low and inventory unit value is relatively high. Specific ID, the big hitters, okay? Inventory costing using color printers. Well, here we go. We had 40 units at the beginning at 62. And then we bought 60, 80, and 70 more. Notice the prices are going up, okay? I don't know if I need to, I don't think I need to mention this for our class, but in 230, they give you problems where the prices are going down and we ignore those. I guess my point is always think in terms of rising prices. That's a normal economy. Any economy that grows and wants to create jobs and wealth has to have a certain amount of inflation. People have to make a little bit more money. You know what I mean?
Mhm.
If we're going to teach what happens in a period of falling prices, we're teaching you how to go out of business, really. Teaching you how to go into a horrible depression. So we're familiar with this. Number of units available, 250.
Mhm.
There's 50 left on hand, so we sold 200. How do we turn the $16,500 available into inventory dollars and sales dollar, cost of sales dollars? Specific ID. Just like I told you, Lori, they're telling you here the identity of the 200 printers, 30, 50,
Mhm.
60, 60. 30 came from here, 30, 30, etc. Okay.
Mhm.
So the cost of goods sold is the cost of 200 printers sold. Here is your specific ID method, specific ID.
Mhm.
They told you that they sold 30, 50, 60, 60 from these layers here. So this is your cost of goods sold, right?
Mhm.
Let's look at these, let's look at the layers here. We had 40 and we sold 30 of the 40, correct? From here,
Mhm.
that leaves you with 10 in the inventory. Any questions on this, Lori? Make a little bit of sense?
It does, yeah.
This stuff, this part of the chapter, this part of the costing method is pretty easy. But you know where they drive you nuts in 230, at least in the McGraw-Hill book that we've been using for a long time? I think they said to themselves, well, this is too easy, so we're going to try to make it a little bit harder. And they make up the question this way. They say something like the Johnson Company sold 1/5 of its total sales out of 2/3 of the second purchase. And you can't even read it. You have to do a flow chart just to read what they're talking about. And it drives me and the students crazy. We don't have that problem here. FIFO. FIFO. This is kind of a normal flow of goods, not exactly, but it assumes that the first goods purchased were the first goods sold.
Mhm.
So the most recent items are still in the inventory. Let me get a little sipper. Whenever possible, a business will attempt to sell the older goods first. Common sense.
Mhm.
Grocery stores, there you go, bakeries, computer dealers. And FIFO can follow the movement of the goods, but not necessarily, okay?
Mhm.
Let's look at FIFO. Remember we sold those 200? Here we go, specific ID. We sold those 200, right, Lori?
Mhm.
And they told us, well, 30 are going to be times 62, 50 times 65. Under FIFO, which ones did we sell first?
So the 40.
Yeah, we sold the 40, the
And then
60, 80, and the remaining 20 out of the third tranche here.
Mhm.
So we got 40, 60, 80, 70. 40, 60, 80, 70. So let's see. We sold 40. Next purchase, we used up all of those, right? Next purchase, we used up all of these 80. We're looking for 200. So we used 20 out of that 70,
Mhm.
which means we have 50 left in the ending inventory at $68. Okay. Make a little bit of sense here?
Mhm.
Yeah, just gotta, kind of practice your way through it a little bit. It can be a little tricky when you're trying to think in terms of cost of goods sold versus the inventory. Weighted average method. This is super easy. Weighted average method. Weighted average method. I'm deliberately going back here for a reason. You see the available for sale line, Lori?
Mhm.
You have a calculator there? 16,000, that's okay. 16,500 divided by 250
Mhm.
would be your average cost. My
Okay,
point is that's all you have to do. Once you get the 16,500, yeah, I don't have a calculator either. 16,500 divided by 250, whatever it is, you're going to multiply that by 50 and by 200.
okay.
And they're going to show that to us here, I guess. Here we go. $66 a unit.
Mhm.
So there's none of this LIFO, FIFO stuff. All you do is multiply the goods you sold by 66
Mhm.
and the units left in the inventory by 66. Weighted average. Don't make the mistake some students make. Instead of going 16,500 divided by 250, they'll add the unit prices up. They'll go 62 plus 65 plus 67 plus 68 and divide by 4. And that's not going to be the right number. The only way that works, Lori, is if all the units were the same.
Right.
Easy, it's an easy mistake to make, though. It really is. Cost of goods using the average. Here we go, 200 times 66 in the inventory. One of the advantages of this method is its simplicity. Simplicity. Last in, first out. Oh, assumes that the sales in the period were made from the most recent purchases, so that the oldest inventory, that 80-year-old bunch of bananas is still in the inventory. Justification for this method: physical movement of goods in some businesses is actually last in, first out. Although I can't think of an example of that, can you?
I can't think of anything.
Not me. You know, the only thing I can come up with is a hardware store, maybe. You know, you opened up a hardware, your family opened up a hardware store after World War II, and you had a gigantic 50-gallon drum, and you filled it up with nails. And people come and they grab nails and you weigh them and they buy nails. And then when that barrel gets maybe 2/3 empty, you pour more nails on top. So maybe you never do so first nails. I don't know. I may not know what I'm talking about, which is something you probably figured out. Periodically, last in, first out. It does match the most current cost of items against the current sales, huh? It results in lower net income. Remember, under these 4 methods, you're going to end up with 4 different net incomes. FIFO will give you a higher net income than LIFO. FIFO gives you a higher net income because, Lori, you are selling the lower costed goods first. If you had you had a beginning inventory plus purchases plus purchase, and you sold, say, one item, well, under FIFO, you would go and sell it for $100 because that was the price at the beginning of the month. So your cost of goods sold on that sale would be just 100. By the end of the month, though, the price had gone from 100 to 200. Under LIFO, that's the cost you would assign. FIFO will give you a higher income than LIFO. And there are reasons companies might choose FIFO or LIFO. The average costing method will always be between LIFO, FIFO by definition, and specific ID is unpredictable. You just don't know where that's going to go. Okay. LIFO method. Look at this. Look at our cost of goods sold. My goodness, we sold this one, the 70 first. 70 and 80, 150 plus 50. Under this method, we still have 10 units from the first purchase, and the beginning inventory is still sitting there under this method. So what we're saying here is our cost of goods sold here is 13,370, and the ending inventory is 3,130. I used to like to do these when I was working, when I first got out of school. I always thought this was kind of a fun thing. Physical flows and cost flows. Identify the specific ID method with the ABB. Let me just look at this here for 1 second. Specific ID will necessarily reflect costs now that match. Yeah, well, we know that the specific ID matches the flow of the goods. Assumed costs. Now that I read this a little more carefully, this is a good sheet. The specific ID method matches the actual flow of the goods. That's your vehicles, your cars, your trucks, your diamonds. Assumed cost flows. That's a good word. Assumed cost flows. FIFO, LIFO, weighted average have nothing to do not reflect the actual physical movement of the goods. Any one of these methods could be used under any set of physical flow conditions. I guess now we're going to look at, I hope, yeah, good. Let's look at what happens now. This is so important, Laurie, this first sentence, and I know you know this already. Cost of goods available is the same, right, for all methods.
Mhm.
Cost of goods available, that's all what happened in the past. At the beginning of the month, we had $100 worth of goods, and then we had 4 or 5 purchases, and now we have $1,000 available to sell. So your cost of goods available is just the starting point for all of them. The ending inventory and cost of goods sold totals will differ, of course, with each method. Gross profit will have differences. When prices are rising, and that's all we're going to talk about, rising prices. You're never going to get a problem from me on falling prices. When prices are rising, FIFO will give you the largest profit, gross profit or net profit. LIFO results in the smallest gross profit, therefore creating the smallest tax liability. Let's take another look here. When selecting the inventory method to be used, the IRS requires the use of the same method for tax and financial purposes. The physical flow, again, they want to emphasize this, has nothing to do with the assumed inventory methods. And the consistency principle requires the same accounting methods be followed from period to period. If you're a company on the Dow Jones, you know, you're doing financial statements according to GAAP, and you give your financial statements out for the purposes of attracting investors or being able to borrow money, you must stick with the same inventory costing methods for a while. If you choose to change them, it's kind of a big deal, and you have to go through a terrific calculation to come up with the difference that will result from changing methods. And there's certain principles about accounting for that. The key thing is for our course here is, if you got FIFO in January, you got FIFO for the next 11 months, probably, okay? You can't go back and forth fooling around. Companies could do that. If they were allowed to do that, companies would fool around with this depending on what's going on, huh? Hey, we had a good month in January. Okay, let's use LIFO this month and cut our taxes down, that type of thing. And here is a very, very important grid to look at. Here is our income statement. And this income statement is the same under perpetual or periodic. Sales of 18,000, that's the common thread. Goods available for sales, the same, 16.5. Under FIFO, I like to start with LIFO. Our gross profit was 4,900, was it not? Under LIFO on the right, it was only 4,630. So that's a difference of 270. You know, let's say this is a big company that's 2.7 million. They just saved themselves, 30% of that. They saved about $800,000 in taxes. Weighted average will always be in the middle. and specific ID, just depends which ones they bought. So the key thing here is understanding FIFO gives us the highest net income because you're costing out the earlier goods, which are at a lower cost. Okay, so I urge you all to look at this. Take it a little step further. Your ending inventory is going to be higher for FIFO. It's going to be lower for LIFO. And again, average in between. Okay. Remember we were talking earlier about the effect of mistakes, where we said if you overcount the inventory, you inflate the profit. That's kind of what we're doing here. We have a higher ending inventory here under FIFO because we are assuming the most recent, more expensive purchases are still in that inventory. Okay. Perpetual inventory system, continuous record is maintained for quantities, much easier. Yeah, this makes sense. Much easier to handle with computerized systems. Absolutely. The balance of the merchandise inventory account at any time shows the cost of goods that should be on hand. And that's like I said, you call up a store now, they'll be on a perpetual system. You call up even a supermarket, I bet. You call them, do you have this special cut of roast beef? Oh yeah, we got 5 right here. The merchandise inventory account at any time should be matching your perpetual records. Merchandise inventory is a control account. A control account simply means everything in your chart of accounts, right? Cash is a control account. Accounts receivable is a control account. The accounts receivable listing of your customers, that's a subsidiary. A subsidiary ledger is maintained with an account for each type of merchandise. So you might see Chanel bottle 5, and you'll see one T account just for that. And you'll see the pluses that came in and the minuses that went out, the debits and credits to that particular item. Goods sold usually are assigned cost on either a FIFO, moving average, or LIFO basis. I think that's accurate. I don't think we'll go over this too much. I've looked at this for the last few years, okay? Don't worry about the FIFO method. I mean, on the perpetual side. We're going to skip that. Conservatism. When in doubt, a lower asset value and net income measure should be used. We're going to learn about something called the principle of lower of cost or market. Lower of cost or market. If an asset increases in value while being held, like a piece of land you might have bought 50 years ago, no formal entry of the gain is made on the books until it's sold. You can never anticipate a gain from the increased market value of an asset. You can only record that gain when you sell it, okay? Now, that doesn't mean you can't go to a bank and the bank looks at your balance sheet and you say, this land you own is only worth $50,000. And you say, yeah, that's what we paid for it. And my great grandfather paid for it. Now it's worth 10 million. And, you go from there. But if an asset decreases in value while being held, you must record a journal entry to record that loss. We should never anticipate gains, but we should always anticipate and account for losses. Part of the conservatism principle. So what are we talking about? What are we talking about? It's called the principle lower of cost or market. When the value of an inventory declines while it's being held, the loss should be recognized immediately, should be recognized in the period of decline. Purpose of this, recognize losses on the income statement and recognize that your inventory is no longer worth what you thought it was. Lower of cost or market. Cost, we know what that means. This is what you paid for it, right? Cost. Cost means dollar amounts calculated using your inventory methods. Market means what it would cost you to replace it today. Okay. Price in the market in which goods are purchased by the business. Market. Just what it means. Price in the market in which goods are purchased by the business. Not the price in the market in which goods are normally sold by the business. And we'll go over that and hopefully clarify that a little bit. The method assumes that a decline in the purchases in the purchase replacement price is accompanied by a decline in the selling price and thus signals a decline in the value of the inventory. Not sure I like that line, but here we go, Lori. Let's take a peek here. We have 3 items in our inventory, right? Item 1, 2, 3. Look at item 1. We paid $8,000 for this item, right?
Mm-hmm.
And then at the end of the month, your salesmen are coming back to you and they're saying, no one's going to give us $8,000 for this item anymore. It's kind of an obsolete item. It's not a popular brand any longer. It's not in style. Our competitors are selling it for a lot less than $8,000. Well, we have to recognize that this $8,000 worth of inventory would cost us $7,000 today. So which one are we going to put on our balance sheet, Lori? Lower of cost or market.
7,000.
Yeah. Look at the next one. We purchased something for 9,000 and it looks like we're still selling them for 10. So the 9 is lower.
Mm-hmm.
We can't write it up, but we can only write it down. And then the third one is the same scenario as number 1.
Mm-hmm.
Price was 7. We know that if we want to buy this stuff again, people only pay, say, $6,500. So we add these numbers up, and now we have a new inventory balance of $22,500. It was $24,500. Now it's $22,500. The difference of $1,500 is going to be a journal entry where you're going to debit something probably called cost of goods sold dash lower of cost or market. I mean, that's what we called it for many years. So we have an asset, we have an inventory that we had valued at $24,000, only worth $22,500 now. Here, I'm not going to get into this too much. When you have a big company with thousands and thousands and thousands of part numbers, using lower of cost or market, you may not have to do it exactly by every single part number, but you can do it in what's called an aggregate, similar items together. If you have 10 of them and 2 of them, 2 or 3 of them turn out to be dogs, you can assume the others are. But in our course here, we're assuming we're doing them each individually. What is our journal entry? Here it is right here. In this case, they're debiting an account called loss on write down of inventory. We called it, in my world, COGS, cost of goods sold dash lower cost market. And what do we credit? The inventory, of course, right?
Mm-hmm.
The inventory is no longer worth $24,000. It was $23,500. I think I said $1,500, $500. I'd like to go back to that. Is that my mistake or the books? I'm proud to say it's the book's mistake. Would you agree?
Looks like it.
They purchased $24,000 and now they're saying it's $22,500. The great Smagula skull tells me the difference is $1,500, not $500. So I'm going to write a little one there. I love picking these books apart.
I'm still here. I just need to grab my computer charger.
Go for it.
Okay. Thank you for the segue.
Hey, I think we're getting toward the end anyway.
Okay.
Here they're giving us something about estimating the ending inventory. You can actually estimate it. And I am not going to go over the slide because I've never done so before. And I don't believe you're going to get any questions on this. But what essentially is, everybody, is if you have a steady gross profit percentage, it's been 30%, 31%, 30.5. The fourth month, you can just kind of estimate it. You can say, well, it's been running 30 to 31%. We'll estimate 30.2 or something. Estimating inventory is not a problem for businesses using the perpetual method. Unverified amounts are generally reliable. I'm deliberately going to go past this, the gross profit method. And then we have the retail method, which I'm not going to look at. And Lori,
Oh, that's it.
we're pretty much done, huh?
Okay.
We're pretty much done. So I think this is a little bit more of an interesting chapter. We're getting into some more real world type things as we go along here.
Mhm.
Costing inventory, costing your sales, the cost of goods sold. Okay. The next three chapters, 13, 14, 15, are all about the perpetual inventory system.
Okay.
And then there's a test I see on April 7th. So we're about a month away from a test. But we have time, I guess, because today's what, the 8th or something like that? Yeah, 15, 22. Well, yeah, we got plenty of time, I guess, to get ready for our next test on April 7th. And then the remaining two chapters are on payroll, which we saved to the end, okay?
All right.
Any questions or anything?
Nope, I'm good.
What's coming out of the oven?
Ooh, I think we'll do some olive oil cake.
Olive oil cake?
Mm-hmm.
Wow, that sounds good.
It's delicious.
Is that a sweet cake or like a bread?
It's actually, well, it's a cake with sugar, but it's not as sweet as like a different, yeah, no, it's not as sweet, but it's still like a sweeter dessert. Yeah.
I tell you, you tell me something with olive oil based baking, I know it's good.
It's
All right.
good.
You take care, Lori.
You too. See you next week.
Goodbye, everybody.